So Section 174 refers to the tax code 174 and is part of the tax law that defines what a specified research and experimentation and software development expense is. You'll hear practitioners use terms like R&D or R&E interchangeably. They mean the same thing. Originally, it was a very, very broad code section of tax law that essentially said if this activity and the related costs can be classified as R&D for tax purposes, or 174, then there's so many different things that you can do with that cost. You can fully deduct it in the year that you incur it. You could capitalize and amortize it over different periods of time. So it was a really lucrative way for tax planning. What changed in 2017, Congress said in the year 2022, companies can no longer have that flexibility with 174. They can't fully deduct those costs anymore. They have to capitalize and amortize them over a period of 5 years if that R&D activity took place in the US, or 15 years if that activity took place outside the US. Capitalization in the context of financial accounting principles is usually a good thing, right? For example, if you purchase a machine that you're using in your business that has a useful life of several years, you would spread the cost of that machine out over those years so you don't take a big hit to your net income in the year that you purchased the machine. And therefore, you would have higher net income in year one than you would if, for example, if you had to recognize the whole expense of that machine in that first year. Well, it works the same way for tax purposes, except that for tax, expenses are a good thing, right? So this new requirement to capitalize R&D and software development costs for tax purposes requires companies to pay a lot more in taxes in the current year than they previously had to under the old rules. That's what was devastating to a lot of companies starting in 2020.
What's an example of a type of expense that would be, that a founder would be able to incur under the R&D tax credit?
There's basically just a small handful of cost types that qualify. So it would be your internal and external labor, if that labor takes place in the US. So it would be W-2 payments or a portion of the W-2 payments that you would pay software developers or anybody in your business who is working on creating something new or improving upon an existing product or process.
Right. A significant portion of your payroll for an early stage startup is the engineering resource.
Totally. Yeah. And then other credit eligible costs would be supplies like materials, prototype costs that are used and consumed in the development process. Computer rental, if you've got pre-production cloud storage that you're using to build and test prototype software platforms and applications in, that's the credit eligible portion of 174 costs. But 174 is much more expansive. It's all cost incident to R&D, and the way that is defined for tax purposes would be, generally speaking, anytime that you are trying to develop or improve a product. And product is defined for this code section as a product, process, algorithm, patent. It also includes all software development costs.
Got it.
Including enhancements and upgrades.
So walk me through some of the founder sentiments or reactions you've observed or seen, either from clients or folks just in the startup space that you interact with.
So I guess, first of all, because this tax law was passed in 2017, and we knew that it was coming for 2022, supposedly, we had it as a bullet point on most of our agendas with our clients, especially if we were discussing the R&D tax credit results for pre-2022 years. But a lot of times it would fall on deaf ears because the sentiment in Congress, publicly, both sides of the aisle were saying, hey, this has to get fixed. This was only included in the tax bill to help show that the tax bills, that the budget would be balanced over the 10-year scoring process that Congress has to do every time they create tax law. So because it was assumed that it would be fixed, even the IRS assumed it would be fixed, which is probably why they didn't issue guidance until towards the end of 2023. A lot of people didn't really pay it as much attention as maybe they should.
Because all signals were pointing green.
Yeah, all signals are pointing to, hey, you probably won't have to worry about this, but here it is. Yeah. So a lot of these conversations, I think a lot of our founder clients, it felt like they were hearing it for the first time. First and foremost, I think a lot of them couldn't believe that this was actually a real tax law. I think some people thought we might have been making up this tax law because it doesn't make sense. Why would you want to, disincentivize companies from doing R&D?
They were shocked and skeptical.
Yeah, because they might not even be profitable when it comes to like how they performed for the year. If they had $100,000 of revenues, but $400,000 of software development costs, on paper, and in reality, they had a loss of $300,000. But since they can't fully deduct that entire amount of $400,000 software development costs under this new law, all of a sudden it looks like they've got all this taxable income.
Yeah, I mean, how does that impact talent planning for startup founders?
I mentioned before that software development costs in the US, you can spread that deduction out over 5 years. And if it's outside the US, you have to spread it out over 15 years. And you have to look at where the activities happen. So you might hire a US-based company to do some application development for you, but if they then engage employees or contractors outside the US, then even though you're paying a US company, you have to amortize that over the 15-year life of the foreign development. I should note that anything that I'm talking about today is within the vacuum of 174. There's all these business implications that would need to be considered.
That makes sense. Tell me about your reaction to seeing this news. Like, what was the day you saw it? What were the emotions you felt? What were the things that were going through your head?
Yeah. So I guess backing up a little bit, in 2017, when this was put into the Tax Cuts and Jobs Act, it was really put in there as a gimmick to show that all the top tax cuts that were in the front half of this 10-year window would be balanced out by these other things that they were burying in the bill to pay for those tax cuts.
In December of 2022, there was a partial fix for 174 costs that was proposed as a part of the omnibus spending bill.
And my dad got really sick in December, and so for the second half of that month, I was in the hospital with him. Early January, I think it was January 2nd, I had a little bit of a breather, and I pull up my phone, and I pull up the omnibus spending bill, and scrolling through, I'm trying to find the section of it that fixes 174. I can't find it, so I get my laptop out, and I open it and Control F, looking for 174 to write in there, and
there must be some mistake.
I was so disappointed.
Yeah.
Because it's bad tax policy, and it's been devastating for so many of our clients, and it's definitely made things a lot more complicated from a tax. Yeah.
So what's the current state of legislation around this issue?
So in January of this year, there was a bill that actually got fast-tracked by the House of Representatives. It was bipartisan. It had overwhelming bipartisan support, which is rare for the House right now. So it got passed, and on January 31st, it got sent to the Senate, and it's been stuck there.
Any reasons why, or just not a priority?
It's a priority. At least that's what we're hearing from people in the Senate. But it's an election year, and what we've heard is that neither side wants to give the other a win before the election.
So this could theoretically be unresolved, maybe going into 2025.
Absolutely. I mean, I think the probability of it being unresolved as of January 1st of 25 is pretty high. If anything happens this year, I would say likely the lame duck session after the election, but it's rare that much happens during that period anyway. So I would say the chances of it getting revisited are very high for next year, because there's also other provisions of the 2017 Tax Cuts Act that are expiring as well. So it's going to force Congress to look at it again in aggregate. I think this hopefully will be at the top of their priority list in terms of fixing. I'd say first, from a prospective standpoint, there are ways that you can prospectively structure future software development engagements if you're hiring contractors to assist you with developing an application or platform, that if it's written a certain way, if that contract is written a certain way, you can it's precluded from being included in 174.
Right.
But those considerations that have to be in the contract are things like intellectual property rights. So if you forfeit those, which what founders going to want to do that, that's one way. So if you have no IP rights and you don't have economic risk, so if it's a fixed fee contract where the third-party contractor has to deliver this app that works for you, they keep the IP, they have the financial risk, it's not your 174 cost. Another consideration that is super important is looking back on your previous expenses to make sure that you're in compliance with the tax law, obviously, and bifurcating your activities and costs into buckets. You've got a bucket that is pure R&D, it's pure software development. If it aligns with all of the 174 requirements, obviously you have to capitalize that. And then on the other side of the spectrum, if you have activities and costs that align with
the statutory exclusions for 174, things like maintenance activities that don't give rise to enhancements, aligning, those costs and keeping them there so that we don't overcapitalize. And then looking at all of the gray area costs in the middle, because this tax law is unsettled. There's all these questions out there that taxpayers are seeking more guidance on, and looking at those and trying to figure out, all right, what's the best bucket to align these gray area costs with? And if we align them over here in the excluded costs, make sure that you've got documentation to substantiate why you did that. They're going to see if you have all these software developers on your payroll, but you have very little software development cost, that's going to look interesting to write, right? So really making sure that if those software developers are truly doing maintenance activities that don't give rise to upgrades and enhancements, that you can substantiate that if it becomes hard. Because you have to capitalize these costs, make sure that you're also claiming an R&D tax credit for the subset of those costs that you're eligible to claim a credit for. But if you've historically claimed an R&D credit and your R&D costs have decreased in recent years, let's say that you developed a platform or application in 2021, it's in production, things are going well, now you're just monetizing it, but if all the other activities are maintenance, really make sure that you're documenting what changed in the business between 2021 and 2, or between 2022 and 23, to help support that narrative that you really did have decreased R&D costs between those years. And then I think the other consideration is, there's not a one-size-fits-all approach to this. So if you're in tech or consumer goods, you likely have a lot of these 174 types of costs. So it probably does make sense to work with an expert professional who can help you navigate that space. But if you're outside of those two industries, you might not have a whole lot of 174 costs. So it might not make sense to hire a professional to do a full-blown study. It might just be aggregating all the invoices and making sure that you're claiming those. So it's going to vary based on that. And then the other important consideration is if you're profitable, if you're in an income tax paying position, there are different tax planning strategies. Because 174 is such a broad, full encompassing area of tax law, if you want to maximize the amount of cost that you're capitalizing, you can. And that might be a really great way for you to tax plan and make sure that you're aligning your future income streams with these deductions that you can amortize over future years, especially if you're not able to use your NOL carry forwards into future years given different limitations. So lots of things to consider. But at the end of the day, we'd recommend at least talking to a professional.
Aprio is a CPA-led business advisory firm with offices all over the U.S. We have more than 2,200 employees globally and more than 40 fully dedicated R&D professionals that would be happy to assist with any Section 174 or R&D tax credit needs.
And try to see what approach would work best for you and how we can do that most efficiently for you.
That makes sense. Well, thanks for joining me, Dave. I think this was super helpful.
Absolutely.